He was not a speculator. He was a journalist, an analyst, and the market's first true philosopher. He sought to look through the chaotic, speculative frenzy of his era and find an underlying logic, a hidden structure that could explain the seemingly random movements of the market. In doing so, he not only co-founded the Wall Street Journal, but also laid the intellectual foundation for nearly all of modern technical analysis. His name was Charles Dow. This is the story of the Dow Theory, the first coherent framework for understanding market trends. It is the examination of a man who was not trying to create a system for generating quick profits, but was on a far more ambitious quest to create an honest, reliable barometer of the American economy's health. He believed the stock market, for all its flaws, was the most powerful tool for this task, a sensitive mechanism that reflected the collective hopes and fears of an entire nation. To harness it, he first had to map it. We will begin by exploring the life of the man and the historical context that drove his mission. We will then deconstruct the tools he forged, the famous Dow Jones Averages, and finally, we will begin our deep dive into the foundational tenets of his timeless theory. To understand the Dow Theory, one must first understand the man. Charles Henry Dow was born on a farm in Connecticut in 1851. He was not a product of East Coast financial aristocracy. His upbringing was modest and his formal education ended at a young age. His true education began when he left the farm to pursue a career in journalism. As a young reporter, he developed a distinct style, a gift for explaining complex subjects in clear, concise language, and a deep fascination with business and economic history. He honed his craft at various newspapers, eventually landing at a financial news agency in New York City. It was here, in the heart of American capitalism, that he met Edward Jones, a fellow journalist who shared his commitment to honest, objective reporting. In 1882, the two men, along with Charles Bergstresser, founded Dow Jones and Company. Their initial product was a series of short, handwritten news bulletins delivered by messengers throughout the day to the brokerage houses and banks of Wall Street. This was a radical idea for the time. The Gilded Age was an era of rampant market manipulation. The financial world was dominated by rumors, misinformation, and powerful speculative pools run by insiders who would conspire to drive stock prices up or down for their own enrichment. The average investor had no access to reliable information and was treated as little more than cannon fodder in the games of these powerful operators. Dow and Jones sought to change this. Their mission was to provide unbiased, accurate, and timely financial news. This mission culminated in 1889 with the creation of their flagship publication, the Wall Street Journal. Dow, as its first editor, established the paper's intellectual and ethical tone. He believed that the only way for the public to participate in the markets fairly was if they were properly informed. But to be truly informed, they needed more than just news about individual companies. They needed a way to understand the health of the entire economic system. This quest for a reliable measure of the nation's business health became his life's great work. The late 19th century was a period of unprecedented industrial growth in the United States, an age of steel, steam, and electricity. But it was also an age of extreme volatility. The economy was racked by a series of brutal financial panics and deep depressions, most notably the panics of 1893 and 1896. There were no reliable real-time government statistics to measure economic activity. Business leaders, politicians, and the public had no objective way of knowing if the country was in a healthy boom or on the verge of a catastrophic bust. Dow believed he could solve this problem. His great intellectual leap was the insight that the stock market, despite its speculative excesses, was the most sensitive and comprehensive barometer of business conditions available. He reasoned that the collective judgment of thousands of investors, all risking their own capital based on their knowledge of their specific industries, would create a consensus view that was more accurate and forward-looking than any other measure. The market's price movements, he believed, were not just a reflection of speculation, but a direct reflection of the current and, more importantly, the future prospects of American business. To harness this barometer, he needed a tool. A single stock was too volatile and idiosyncratic to be a reliable guide. He needed a way to measure the market's overall tide. His solution was the creation of a stock average. His first attempt, created in 1884, consisted of 11 companies, 9 of which were railroads, the dominant industry of the era. But as the American economy evolved, Dow realized he needed a more refined tool. On May 26, 1896, he published his new revolutionary index, the Dow Jones Industrial Average. It consisted of 12 of the most important industrial companies of the age, giants that represented the new backbone of the American economy. The original list included names like General Electric, American Cotton Oil, and the Chicago Gas Company. This index was designed to be a proxy for the productive capacity of the nation, but Dow knew that production was only half of the economic story. A healthy economy did not just make goods, it had to transport them to market. To capture this vital other half, he also created the Dow Jones Railroad Average, which would later evolve into the Transportation Average. This two-index system was his greatest conceptual innovation. It was a complete, logical model of the American economy. The industrials represented the production of goods, and the railroads represented the movement of those goods. He believed that a truly healthy, sustainable economic expansion required both averages to be moving in the same direction. One without the other was a signal of an underlying imbalance. With these two powerful analytical tools in hand, Dow began to study their movements, and from his observations published in a series of editorials in the Wall Street Journal, his disciples would later codify the set of principles known as the Dow Theory. The Dow Theory is not a system for predicting stock prices. It is a framework for identifying the market's primary trend and gauging the overall health of the economy. It is built upon a set of 6 core tenets, which we will now deconstruct. The first and most profound of these tenets is the principle that the market discounts everything. This is the intellectual foundation of the entire theory. It posits that the current price of the averages at any given moment reflects the sum total of all available knowledge and information that could possibly affect the supply or demand for stocks. This includes not just the hard, quantifiable data like a company's earnings, dividends, and balance sheets, but also a vast array of other factors. The current level of interest rates, the inflation rate, the political climate, and even acts of God like droughts or earthquakes. Furthermore, and most importantly, it also discounts the future expectations of all market participants, their collective hopes for future growth and their collective fears of a future recession. The implication of this tenet is immense. It suggests that trying to make investment decisions based on a single piece of news or a single fundamental data point is often a futile exercise, because that information is likely already in the price by the time the average person receives it. The price itself is the most complete, up-to-date, and relevant piece of information available. The job of the analyst, therefore, is not to act on the news, but to study the price action of the averages to interpret what the news means for the market's trend. This idea, formulated in the 1890s, was a radical departure from the rumor-driven speculation of the time. It was the first formal expression of the concept that would, nearly a century later, be called the efficient market hypothesis by academic economists. It is the bedrock principle that allows for the study of price charts as a valid form of analysis. This brings us to a foundational debate for all modern market participants. Do you believe Dow's century-old principle that the market discounts everything still holds true in today's world of high-speed algorithms, social media-driven manias, and complex derivatives that can create hidden risks? Or are there now factors and speeds that the market simply cannot price in efficiently? Let us know your thoughts in the comments. The second tenet of the theory is that the market is comprised of 3 distinct trends, each operating on a different timescale. Dow's understanding of this concept was brilliantly illustrated by his famous analogy to the ocean. The first and most important trend is the primary trend, which he compared to the ocean's tide. This is the major long-term bull or bear market, which can last from 1 to several years. For the long-term investor, identifying and aligning oneself with the primary trend is the single most important task. A primary bull market is a long, broad upward movement, characterized by rising prosperity and improving business conditions. A primary bear market is a long, broad downward movement, characterized by declining business activity and economic distress. The second is the secondary trend, which Dow compared to the waves. These are intermediate corrections or rallies that move against the direction of the primary trend. A secondary reaction in a primary bull market is a significant decline, typically lasting from 3 weeks to 3 months, and retracing between 1/3 and 2/3 of the previous primary advance. Conversely, a secondary rally in a primary bear market is a significant advance of similar duration and magnitude. These secondary trends are dangerous traps for the uninformed, who often mistake a normal correction for the start of a new bear market, or a bear market rally for the start of a new bull market. The third is the minor trend, which Dow compared to the ripples on the waves. These are the short-term fluctuations that last less than 3 weeks and often just a few days. For Dow, the minor trend was largely insignificant noise. He believed that these short-term movements were highly susceptible to manipulation and random events, and he warned that attempting to profit from them was a dangerous and often losing game. This 3-part classification was a revolutionary framework. It gave analysts for the first time a way to contextualize market movements. It provided a structure for understanding whether a sharp sell-off was merely a minor ripple, a healthy secondary correction within an ongoing bull market, or the first, ominous sign that the primary tide had turned. The third foundational tenet of the theory, which we will cover in this section, is that a trend is assumed to be in effect until it gives a definitive reversal signal. This is the market's version of the legal principle of innocent until proven guilty. It is a rule of patience and discipline, designed to prevent the analyst from prematurely calling a top or a bottom. Dow understood that a trend in motion is far more likely to continue than it is to reverse. The burden of proof, therefore, is always on the reversal. A simple one-day sell-off, or even a week of declining prices, is not sufficient evidence to declare that a primary bull market has ended. It is more likely to be a minor or secondary fluctuation within that larger trend. But what constitutes a definitive signal? This is where the theory's logic becomes truly powerful, and it sets the stage for the principles of confirmation that we will explore in the second part of this analysis. To confirm that a primary bull market has reversed into a primary bear market, the theory requires a clear and unambiguous pattern of declining peaks and troughs in both the industrial and the transportation averages. After a bull market peak, the averages will experience a secondary correction, making a lower low. They will then have a secondary rally, but this rally will fail to exceed the previous peak. The definitive signal of a new bear market comes when the averages then decline once more, breaking below the low point of the preceding secondary correction. This pattern of lower highs and lower lows, confirmed by both averages, is the objective evidence that the primary trend has changed. The psychological benefit of this rule is immense. It forces the analyst to wait for the market to provide clear, objective proof of a trend change, rather than acting on their own emotions, opinions, or forecasts. It is the ultimate tool for combating the dangerous and often costly impulse to try to perfectly time the market's turning points. These first 3 tenets, that the market discounts everything, that it moves in 3 distinct trends, and that a trend persists until proven otherwise, form the core philosophy of the Dow Theory, a timeless framework for mapping the market. In the first part of our analysis, we established the foundational philosophy of Charles Dow. We explored his background as a journalist, not a speculator, and his mission to create an honest barometer of the American economy. We deconstructed the tools he forged for this purpose, the industrial and transportation averages, and we examined the first 3 core tenets of his theory: the profound idea that the market discounts all available information, his classification of the market into 3 distinct trends, and the principle that a trend remains in effect until it gives a clear and definitive signal of its reversal. These principles formed the intellectual bedrock of his approach, a way of seeing the market as a logical, structured entity. Now we transition from the philosophical foundations to the practical application. If the first part was the theory, this second part is the diagnostic manual. We will explore Dow's specific objective tools for confirming the health of a trend and for identifying its psychological state. We will deconstruct the most famous and powerful tenets of his theory, the crucial principle of confirmation between the averages, the vital role of volume in validating price action, and finally, his brilliant and timeless model of the three psychological phases of every major market trend. These are the concepts that transformed his observations from a collection of ideas into a coherent and actionable methodology, the very methodology that would become the foundation for a century of technical analysis. The fourth and most famous tenet of the Dow theory is the principle of confirmation, which states that the averages must confirm each other. This is the practical heart of his two-index system and his most powerful tool for gauging the underlying health of a primary trend. The logic behind this principle is a profound and elegant metaphor for a healthy, functioning economy. Dow reasoned that the industrial average, representing the great manufacturing and production companies, was a proxy for the nation's ability to produce goods. The railroad average, representing the shippers and transportation companies, was a proxy for the nation's ability to move and sell those goods. A truly healthy and sustainable economic expansion, he argued, requires both of these functions to be operating in harmony. It is not enough for factories to be producing goods. Those goods must be shipped to consumers to generate real economic activity. It is a closed loop of production and commerce. When the averages are in harmony or confirming each other, the signal is one of strength. In a primary bull market, this means that both the industrial average and the transportation average are making a series of successively higher peaks and higher troughs. This harmonious action tells the analyst that the economic expansion is broad-based and robust. Industrial production is strong, and the transportation sector is busy shipping those ever-increasing amounts of goods. The economic tide is rising, and it is lifting all boats. The true power of this tenet, however, lies in its ability to issue a warning signal. This signal is non-confirmation or divergence. This occurs when the two averages fall out of sync with each other, telling two different stories about the economy. This divergence is one of the most reliable and historically significant warnings of a potential major market top. The classic non-confirmation scenario is when the industrial average pushes to a new high, but the transportation average fails to do so. This divergence suggests a dangerous underlying weakness in the economy. It implies that while factories may still be producing goods at a high rate, perhaps driven by the final euphoric phase of a bull market, those goods are not being shipped with the same velocity. This points to a slowdown in final demand and the beginning of a buildup in unsold inventories, a classic precondition for a recession and a subsequent bear market. The shippers, who are closest to the real day-to-day flow of commerce, are sending a signal of caution that the more speculative industrial sector is ignoring. The historical record provides powerful and repeated validation of this principle. The period leading up to the Great Crash of 1929 is a textbook example. Throughout the euphoric advance of 1929, the Dow Jones Industrial Average soared to its ultimate peak on September 3rd. However, the Dow Jones Railroad Average was telling a very different story. It had peaked months earlier and was already in a clear pattern of decline, failing to confirm the industrial's final speculative push. The arteries of commerce were signaling a slowdown long before the heart of the speculative market gave out. An even clearer example occurred before the 2007 to 2008 financial crisis. The Dow Jones Industrial Average reached its all-time high on October 9, 2007. But the Dow Jones Transportation Average had peaked nearly 3 months earlier, on July 5, 2007. For 3 crucial months, the two averages were in a state of major non-confirmation, with the shippers of goods warning of an economic slowdown that was being completely ignored by the broader market. This divergence was a clear objective signal that the primary bull trend was internally unhealthy and acutely vulnerable to a reversal. The fifth tenet provides a second layer of confirmation, a tool for gauging the intensity and validity of a price move. This is the principle that volume must confirm the trend. For Dow, if price was the ultimate indicator of what was happening in the market, then volume was the indicator of how it was happening. Volume represents the emotional intensity, the level of participation, and the conviction behind a price move. A price trend that is not supported by a corresponding volume pattern is suspect and unlikely to be sustainable. Dow laid out a clear set of rules for what healthy volume patterns look like within a primary trend. In a primary bull market, volume should expand as prices rally and contract during secondary corrections. The logic is intuitive. As prices rise in a healthy uptrend, enthusiasm grows, and more participants are eagerly buying, which is reflected in higher trading volume. During the inevitable corrective pullbacks, however, volume should dry up. This low volume on a decline is a positive sign, suggesting that the selling is not aggressive or panicked, but is rather a period of quiet profit-taking. There is no significant supply emerging to threaten the primary trend. In a primary bear market, the opposite pattern should be observed. Volume should expand as prices decline and contract during secondary or bear market rallies. The rising volume on the declines reflects the growing fear and panic that is fueling the selling pressure. During the corrective rallies, however, volume should be anemic and light. This low volume on a rally is a bearish sign, suggesting that the buying is not driven by any real conviction, but is likely the result of short covering and a few bottom fishing attempts. There is no significant broad-based demand entering the market to absorb the overhead supply. A divergence between price and volume is a crucial warning signal of a trend's potential exhaustion. For example, if a bull market makes a new price high, but it does so on noticeably lower volume than its previous peak, it is a sign of waning enthusiasm. The advance is unhealthy, and the trend is running out of fuel. It suggests that the smart money is no longer actively participating, and the final advance is being driven by a smaller and less informed group of participants. By carefully observing the relationship between price and volume, a Dow theorist can gauge the health and intensity of the primary trend and receive early warnings that the underlying forces of supply and demand are beginning to shift. The final tenet we will explore is Dow's third, and it is the psychological heart of his entire theory. This is the principle that primary trends have three distinct phases. Dow observed that major bull and bear markets were not monolithic movements, but were instead social and psychological dramas that unfolded in three clear acts. His description of these phases is one of his most brilliant and enduring contributions, as it provides a timeless model for understanding the flow of information and the shifting emotional states of market participants. The first phase of a primary bull market is phase 1, accumulation. This phase occurs at the tail end of a preceding bear market. The economic news is still overwhelmingly negative. Corporate earnings are poor, and public sentiment is one of complete despair and disgust with the stock market. It is during this period of maximum pessimism that the most astute and well-informed investors, the smart money, begin to buy. They recognize that the worst of the economic damage has been done, that the market has fully discounted all the bad news, and that securities are now available at prices far below their long-term intrinsic value. Their buying is done quietly and patiently without creating much of a price stir. On a chart, this phase typically appears as a long, dull, sideways basing pattern, where the stock is churning near its lows as shares are slowly transferred from panicked, weak hands to confident, strong hands. The second phase of a primary bull market is phase 2, public participation. This is typically the longest and most sustained phase of the advance. It begins as the economic fundamentals start to improve. Corporate earnings begin to recover and then accelerate. Business activity picks up and the news flow slowly shifts from negative to positive. The trend is now clearly upward, and the broader investing public begins to re-enter the market. Technical traders are attracted by the bullish price patterns, and fundamental investors are attracted by the improving earnings picture. This is the healthiest phase of the bull market, a period of steady advance supported by genuine improvements in the real economy. The third and final phase of a primary bull market is phase 3, distribution. This is the phase where the market becomes detached from reality and transforms into a speculative mania. The economic news is universally positive, corporate earnings are excellent, and the market is now a front-page story. The public, which was cautious in phase 2, now becomes wildly euphoric, driven by greed and a fear of missing out. Stories of ordinary people making fortunes in the market become commonplace. It is during this period of maximum optimism that the same smart money that bought during the accumulation phase now begins to methodically sell or distribute their holdings to the ecstatic and unsuspecting public. On a chart, this phase is often characterized by a final parabolic advance on massive volume, but the price action becomes volatile and choppy as the large operators unload their immense positions. Dow's description of these phases is a brilliant top-down analysis of mass psychology. For a ground-level, first-person account of living through these very cycles of hope, greed, and fear, there is no better resource than Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. The book's protagonist, the prototype of Jesse Livermore, is a master of identifying the transition from the healthy public participation phase to the dangerous distributive phase. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below. The primary bear market also has 3 corresponding phases: the abandonment of hope during the distribution phase, the selling due to declining business activity, and the final panicked selling of sound securities regardless of their value. By understanding this 3-act structure, a Dow theorist can identify the psychological state of the market, which allows them to gauge the maturity of a trend and avoid the common mistakes of buying during the distributive phase or selling in a panic during the accumulation phase. The first step in building a successful system is building the habit of disciplined study. The Dow Theory is not a set of tips. It is a framework for logical thought that requires reinforcement. If you are serious about developing the habits of objective market analysis, subscribe to this channel and click the notification bell. Let this be the place you come to forge the intellectual framework that will define your future in the markets. In conclusion, the 6 tenets of the Dow Theory form a complete and coherent methodology for market analysis. It is a system built on the foundational idea that the market averages are a reliable barometer of business health. It provides a framework for identifying the market's primary trend through the classification of price movements and the critical principles of confirmation between the averages and with volume. And finally, it offers a profound psychological model for understanding the life cycle of a trend, from its quiet birth in the despair of accumulation to its euphoric death in the frenzy of distribution. The enduring legacy of Charles Dow is that he was not a speculator seeking a fortune, but a journalist and an analyst seeking the truth. In his quest to find a logical structure in the chaos of the market, he gave us the language, the tools, and the core concepts that remain the very foundation of all modern technical analysis. He was the man who first mapped the market,